Okay, so your syllabus also mentions the computerized accounting processes that you need to be able to do. So synthesize and solve goal-orientated problems relating to cash management for a trading GST business. So the goal is to determine the optimum cash budget. We were just looking at this then, looking at how to adjust the cash budget to optimize it. Now, you could be provided with a whole range of different unstructured and unfamiliar financial data relating to cash management. So you could receive bank statements, schedules for accounts receivable and payable, information about the business and its activities, and an incomplete budget or an existing budget with negative bank balances. Okay, now to the computerized accounting processes. So you'll need to be able to use these to apply these to record transactions. And there can be lots of different types of transactions, all the sorts of ones that you would have encountered previously in other units in accounting. So opening entries, purchasing non-current assets, other revenues and expenses, etc., etc. You also need to carry out bank reconciliation, which is what we looked at earlier, but this is doing so in that computerized accounting format. Record balance day adjustments, generate end of period reports and financial statements. So, for example, our statement of profit or loss and statement of financial position. The implementing the end of year processes to ready accounts for the new financial year, and record or process reversing entries. So what are computerized accounting processes then? What does that refer to? These are the processes that you apply when you're using software like MyOb, QuickBooks, or Xero to set up your accounts, enter transactions, and report your accounting information. So you will learn in class how to use usually just one of these platforms, depending on what your school selects, and you'll be learning how to do all of these things that you should be pretty familiar with in the manual written format. You'll learn how to do them in those computerized formats as well. So I thought we would include just a little bit of an overview of how to record a bunch of different transactions. So you need to be able to know how to use the accounting software. It's going to have a different interface where you need to know what buttons to click to get to certain things. But just being able to have that general understanding of the recording of the transactions to begin with is handy. So, for example, in that previous slide where it told us what we needed to know, one of the things was being able to do an opening entry. So that's what we've got to start with here on July 1, an opening entry where we have got all of our different assets listed in the debit column. We've got our credits with our accounts payable and our capital in the credit column, which they add up as always to equal one another out, those two columns. So that's an opening entry because it's the start of the financial year on July 1 in this case. We have got a purchase of furniture on credit. So furniture is our asset that's increasing. An asset is a debit by nature. So it's in the debit column, it's increasing, and so it stays in that debit column. Accounts payable is a credit, and that is increasing. Accounts payable is a credit by nature, so it stays in that credit column. Always think about what is the account that I'm thinking about? What is the nature of that account? So debit or credit. Is it increasing or decreasing? If it's increasing, then it stays as its nature. So if it's a debit that's increasing, then you debit it. Whereas if it's the opposite, then you do the opposite. So if it's an asset that's decreasing, then it is an asset that's being credited, and so you would need to decrease that figure and credit that figure. We've got the additional payment for the delivery of furniture. Watch out when you've got those little extra things that are said in the instructions. Sometimes they'll say you purchased furniture on credit and you also had a delivery fee, and it's easy to get the first bit and forget the second bit. So always be really vigilant for little things like that. We've got cash sales, cost price of inventories. So when you've got sales, you need to also account for the loss of those inventories that were involved in that sale. So when you're given the instructions for your general journal records, you will be told what the cost of goods sold is, and that will allow you to then do that second entry that involves cost of goods sold and inventories. Next up, we've got a few others. So we've got, for example, drawings on the 6th of the month. So drawings for $54. We've got the cash at bank for cash sales again, and inventories going down, cost of goods sold going up. We've got the owner withdrawing cash for personal use. So drawings, a way that I like to remember this is we know that drawings needs to be a debit because it starts with DR, and that is our little acronym for debit. So drawings is in our debit, and cash at bank, our asset of cash at bank is going down because money is being withdrawn for personal use away from the business and to the owner for personal use. So there's no GST for drawings transactions like this. It's just the two accounts. When we're paying accounts payable in full, remember our cash at bank is going down. That is our asset that's going down, so it's credited. And then the accounts payable, which is our liability, our credit, is going up, so that is credited. And let's see, we've got more different revenues. So, for example, on the 24th, we've got commission revenue. So, cash at bank is going up. Commission revenue is a credit by nature, and so that is credited because it's also going up. And you figured out the GST component of that as well. Remember that wages doesn't have GST. Keep that in mind as well. We can see that on the 30th of the month. It's simply just wages and cash at bank. Now, we've also got on the 31st the correction of error made on the 22nd of July. So we would have been told in our instructions that there was an error made on that date. So we've done a correction to address that. I encourage you to have a look at all of those in more depth, to have a look at the different things that were shown, and the interrelationships between different things as well. Try and backtrack and think, this is the transaction, so what would the instructions have been in order for me to then do that transaction in the general journal. Now we're moving on to have a look at some of our balance day adjustments. So we have got prepaid expenses. to start with. These are expenses that arise from a business making payments in advance. So in the current accounting period, they are making a payment for goods or services that they aren't going to receive until the next accounting period. So maybe they make a payment for something in June, and then they're not going to actually receive that thing until the next accounting period in July. So, for example, you may make an advanced payment like this on something like a car, because you need to order it and pay for it to start with, but then you're not going to receive it for a while because it needs to be transported to you. So to record a prepaid expense balance day adjustment, you can have one of two general journal entries. It depends on whether the prepaid expense is increasing or decreasing. So we've got in our first one there the expense account increasing and the prepaid expenses decreasing. And then we've got the opposite for the second one. So it's really important to know the accounts that are involved, the nature of those accounts, and then think, is it increasing or is it decreasing? And that will help you understand what column it needs to be in, either debit or credit. So accrued expenses. These are expenses that are incurred in that current accounting period, but are yet to be paid. So these are a current liability. Wages and salaries are common examples. And to record this as a balance day adjustment, you need to have a debit to the expense account involved. So it could be wages, for example, and then a credit to accrued expenses. So the general journal entry increases the expense account to the correct amount, because we've actually got more expenses, and then it creates an accrued expenses liability account because the amount in the adjustment is owed on balance day. Unearned revenues is also another liability. So when a business receives revenue in the current accounting period that it will not earn until the following accounting period, that is when we have an unearned revenue. You haven't earned the money that you've received yet. So to record this, you want to have a debit to the revenue account and then a credit to the unearned revenue account. That's because both of these are a credit by nature. The unearned revenue account is increasing though, so it's credited as per its nature. And whatever the revenue account is, so usually you would list it in more detail. It would be rent revenue, commission revenue, whatever the case may be. And that is a credit by nature, but in this case it's decreasing because we haven't earned the revenue. So we're recognizing that it hasn't actually been earned yet by decreasing that overall revenue figure. So decreases the relevant revenue account to ensure it's representative of the amount that was actually earned in the period. Because any additional money received belongs in the next accounting period. It belongs in the period that you actually earned the money. It creates an unearned revenue liability account because the amount in the adjustment is owed on balance day. Next, we've got our accrued revenues. So this is something that is not a liability this time. So I'll have a bit of a slide later with some tips, and that's going to show you a bit of a trick that I use to help remember what the nature of the different balance day adjustments are. But this one is an asset, so yet to be received revenues, but they've already been earned in the current accounting period. So in this case, we have a debit to accrued revenue and then a credit to revenue. The revenue is increasing, so increases the relevant revenue account to the correct amount, and it creates that accrued revenues asset account to represent that the business is owed money on balance day. So the accrued revenue account is an asset account going up. That is why it's debited. Revenue is a revenue account, a credit by nature. It's also increasing, and so you credit it as per the nature.